Yeah, I guess my question is more around, quality versus net asset value bargains. So you could be looking at a net asset value bargain that is, worth $18, selling at 12, versus looking at a quality company that you think is worth maybe 18 today, but 5 years from now, it could compound to a much higher value as well. And that's whereas, a net asset value bargain or a commodity company 5 years from now might not necessarily have the runway.
I mean, I think that it is always better to buy compounders. It's always better to buy growth. If you're buying an asset because it's cheap, your upside's limited. And so buying cheap assets, in my opinion, is it's not the name of the game. I think what you really want to get to is you want to get to high growth, where the intrinsic value increases over time, but you want to be extremely unreasonable. High growth at a PE of 1. Can we do that? Can we do that? So what you really want is, I mean, what I'm saying is that I think any fool can see that Amazon will grow a lot, Google will grow a lot, Facebook will grow a lot. It becomes a lot harder to figure out what the returns would be when you're investing today. They probably still are good returns. I would say that these are very durable moats, and so they probably wouldn't be around for a long time. And they probably are great investments even today. But, we have 100,000 stocks to choose from. Why not do some digging without spending too much time on one? And why not try to find that diamond in the rough and then take it from there? Like, for example, Charlie Munger said that in 2002, he read Barron's for 50 years, so from the 1950s until 2002. And probably every issue of Barron's has at least 5 or 10 ideas. And so he said for 50 years, he read an issue every week. That's 2,500 issues and 25,000 stock tips. And he didn't act on any of them. He acted on one Barron's stock tip in 2002, which was Tenneco. By 2004, 2005, he had made 8x on that investment. So Tenneco was under distress. The stock went to like $1.60. Eventually, it went to $55. He was out at $15 to $20 a share. But he put 10 million. It became about 80 million in 2 or 3 years. Then he gave the money to Li Lu, and that money is now about, my guess is around 500 million or so. So this is happening in our time. This is not some 1960s story. From 2003 to 2017, without riding Google or Amazon, he got there. The 50x, that's 30% a year or something. So the thing is that what caused that? Well, what caused it was extreme patience, coupled with extreme decisiveness, coupled with being very unreasonable in terms of what he wanted in terms of valuations. And that's the mantra.